Hello and a warm welcome to Econoday Unplugged and what is our final podcast of 2024. It's Thursday, the 19th of December, and on today's edition, we have Terry Sheehan on the US East Coast, Max Arto in British Columbia, and I'm Jeremy Hawkins in London. By and large, then, central bank interest rates are still falling. Over the last couple of weeks, we've had cuts out of the Federal Reserve, Bank of Canada, the European Central Bank, the Bank of England, and earlier today, Sweden's Riksbank. China has offered some strong hints that policy will be eased again, and while lagging the pack, the Reserve Bank of Australia has at least started to sound a little dovish. The Bank of Japan is the main outlier and clearly remains in tightening mode, but even here the process looks likely to be only slow. Still, following Wednesday's FOMC announcement, financial markets have tempered their expectations for how far and how fast rates may be cut going forward. So what does the Econoday team think now about prospects for 2025? Terry, Fed cut 25 basis points yesterday, as widely expected. There was a particularly sharp negative reaction in the asset markets, though. In fact, the S&P 500 posted its steepest post-announcement loss since 2001. So why?
Well, I think they're just really disappointed that the outlook for future rate cuts is now a much slower one. The Fed forecast for next year declined from 4 rate cuts to 2.
Why is that? I mean, not so long ago, financial markets were convinced that we're going to see some fairly aggressive cuts as we go through next year. So what's changed to make the Fed become that much more cautious, do you think?
Well, the most recent data on inflation has what Powell calls us been doing a sideways move, which means that the measures just aren't showing the progress in disinflation that they'd hoped for. We also have a U.S. economy that is coming in above expectations yet again for another quarter, for the third quarter 2024. And it looks like the fourth quarter is also going to be growth somewhere around 2%. The labor market, which has cooled, is not going cold. And so based on the Fed's dual mandate of maximum employment and price stability, they are in the right place right now with rates and therefore in no hurry to cut further.
I guess that's what's going to kind of ask you. You mentioned inflation and there are no surprises in November report, but 2.7% the headline rate. So that moved further above the 2% mark. The core rate, if I remember rightly, unchanged and so still well above at 3.3%. So, I mean, do you think it was actually necessary for the Fed to come out and cut yesterday anyway?
Well, looking through some of the inflation data, some of the things that are pushing inflation up right now are short-term factors like some aspects of food prices here. So I think they're taking that into account when they're looking at the inflation data. But we're also seeing things like inflation expectations stall. And so, out there, consumers and businesses aren't expecting prices to come down very quickly right now. So there are both some short-term factors and also some longer-term factors, like the fact that services costs continue to rise.
All right. So what will the Fed be looking at during the course of 2025? Is there anything particularly new you think they'll be focusing upon, or is it more of the same?
I think it's more of the same, but they've also got a more uncertain outlook right now because, of course, we have a new administration coming in. Mm-hmm. And while there's a lot of talk about changes in fiscal policy right now, we don't know what the actuality is going to be any more than the Fed does. So they're going to have to monitor the situation carefully.
Okay, with regards to that, and this may be an unfair question because we don't really know what's going to happen yet, but Treasury Secretary-elect Scott Bessent, I was wondering if you think he might have any impact on monetary policy. As I understand it, he's determined to try and reduce the government's debt stock. And of course, one very useful way of doing that is to lean on the Fed to cut interest rates to get borrowing costs down and reduce the actual debt service payments. So do you think there could be more pressure coming out from the Treasury on the Fed to do more with rates?
I think there may be more pressure, but I also think that the current Fed is pretty determined not to bow to pressure, but to make their decisions based on the actual data.
Fair enough. All right, then. Interest rates presumably still headed south stateside next year, but what do you think the main risks are?
Well, if we see a sustained uptick in things like energy prices, if the services costs continue to maintain their present path of increases, if we don't see the residual things that have been pushing up the shelter costs in the data ease, then the Fed's probably going to have a harder time making the argument to lower rates.
Fair enough. Anything else from your side, Terry?
No, I think we're good.
Okay, brilliant as always. Thank you very much for that. Max, Canada, where are we? Last week, Bank of Canada chopped another 50 basis points off their overnight rate target. But it seems as if, from what the governor's saying anyway, that 50 basis points may be a little bit too much as far as upcoming meetings are concerned. Is that the right kind of analysis?
Yeah, I agree. It's if you take a look at the level of the interest rate here in Canada, 3.25, and I don't know if you call it ahead of the game, but compared to the US, obviously, Canada started tightening a little earlier than the Fed, and that means they could sort of start lowering rates a little earlier. I think for the world central bankers, they envy probably the US's resilient economy and kind of a controllable inflation, and then also Canada's inflation is right around 2%. So I think that, as the governor Macklem said, the 50 basis point cut is doing a lot of work. So we haven't even seen the full cumulative effects of the previous cuts. So I think the bank is equally concerned about upside downside, but particularly if they cut more aggressively, then that could trigger more active housing investment, which may not be good for controlling inflation at a time when the Canadian dollar is so weak that could push up import costs.
Okay, what about, say, that's in terms of inflation. What about the Canadian real economy? How's that performing at the moment?
Not as strong as expected, but on a smaller scale, I would say still resilient. And as you can see, historically, Canada's unemployment rate is a little higher than in the US, and that's normal. And we still see labor shortage in some sectors. So, but at the same time, we see these seasonal fluctuations, Black Friday, Cyber Monday, maybe volumes were high, but since a lot of retailers cut prices deeply, so the dollar values of the spending may be a little lower. So you really have to sort of even out the data.
All right, and before we leave Canada, let's ask you about a bit on the political side, which again may be a bit unfair for you, but Finance Minister Chrystia Freeland unexpectedly resigned from Trudeau's administration this week. Now, I think widely regarded as a sort of key player in Canada's renegotiation of the North America Free Trade Agreement in Trump's first term. So we got all these threats of new tariffs to come. Do you think her departure could be important in terms of implications for the Trudeau government's ability to survive?
That's a very good question, and you summarized the situation very well from outside Canada. Yes, she was the kind of a minister of everything for Trudeau, but then not just opposition leaders, but from within his own party, everybody's saying, you better quit. But this guy is so stubborn, And I don't know if it's himself or his advisors are dumb. And, just look at the 2-month GST holiday, they're not going to charge federal sales tax on a certain, range of products. But that's, if they have that kind of money, why don't they just put together and do something about the housing crisis? Or like Freeland said, we have to keep the gunpowder dry for the upcoming, for the threat of the higher tariffs from Trump.
Interesting times, isn't it? All right, so let's move on to Asia and Japan. Bank of Japan, no change yesterday. I guess it was a bit of a surprise, or it did seem as if the consensus was quite split as to whether no change or an increase in rates. The fact they didn't do anything, I mean, does that kind of strengthen the case for expecting any gradual interest rate hikes in 2025?
It's, yeah, on the surface, it looks like they didn't do anything. And of course, they didn't have any new outlook because they can't say anything until the January outlook report, quarterly report, to provide more accurate medium-term growth and CPI outlook plus new risk analysis. But I don't think that's going to change much between October and January. And one thing I thought was interesting, listening to, actually watching the governor with his press conference, is that he's kind of using a magic. He keeps the idea of the bank raising rates further, so he has to keep the expectation alive. But at the same time, he or other members would say, we're being careful too. So it's really hard to pinpoint the timing, but January, it was good to talk to, going into the meeting, talk to a former BOJ Assistant Governor Monma, who's now executive economist for Mizuho Research and Technologies. He said his bet is January or even later, and he was right, because as everybody's saying, Japan's consumer spending is weak. And then, as governor said yesterday, he wants to see a little more information about how the wage negotiation is going to go. And judging from the track record of the BOJ, in March and July this year, they went ahead without getting the full picture of how wages hikes going to be in the new fiscal year in April, and then whether they're spreading to smaller firms in the summer. They use the anecdotal evidence from the unofficial interviews by banks' branches across Japan to get a better feel for that. Mm-hmm. So I thought I may have to bet my $20 on going this week, but obviously, as the governor said, they want to see a little bit of more information about how things going to be pan out in the new. I mean, as you know, the annual wage negotiations at big companies will start in January, and you may not even have to wait till March, but that's going to be an interesting time between January and March.
Right. Well, one other thing I'll ask you about, I noticed, I think it's the governor who came out and said that the impact of foreign exchange swings on prices now is larger than it's been in the past, as firms are more willing to raise prices. Do you think this is going to place extra emphasis for investors on the performance of the yen?
No, that's an old piece of information. They said exactly the same thing in October.
Okay.
So I don't think it's a new phenomenon. It's been going on for now.
Okay. Anything else on from Japan?
Japan and Canada, the two countries I've been watching. I guess Canada is going to be obviously an election year. They have to call one before the term's up for the lower house. And Japan, they just came out of a defeat. I mean, for the ruling coalition, and it's going to be interesting to see how much the ruling coalition has to listen to the smaller conservative party in the opposition camp, and that's probably going to be good for the Japanese consumers, because this little conservative party is demanding the government raise the taxable amount, and ultimately to increase take-home pay for lower and middle income families.
Okay. Interesting stuff as always. Many thanks for that, Max. Now, unfortunately, we don't have Bron with us today, but it seems a pretty safe bet to say that rate cuts are on the cards for a number of his region's central banks. China in particular, if local reports are to be believed, it seems as if officials are becoming increasingly concerned over the weakness of private sector demand in general, and certainly the consumer sector in particular. We will see further easing measures in 2025. November data just out showed household spending again undershooting forecasts. House prices are still declining as well. So it seems as if both reserve requirements and interest rates are very likely to be lowered during the course of 2025. And indeed, on the fiscal side, Beijing has also said that it's prepared to let the budget deficit rise. And there's also a lot of speculation about the renminbi yuan will be allowed to fall, especially if Trump follows through on his promise to put a 60% tariff on Chinese imports. So big picture coming out of China is still very much in favour of easing of policy, both monetary and indeed fiscal policy as well. For Australia, Reserve Bank of Australia, well, it looks like they're going to be one of the slowest to follow the easing pack. At the December meeting, they left interest rates unchanged, which was very much in line with expectations. And indeed, it's been a steady official cash rate, 4.35% for the best part of a year now. Central bank suggested they didn't explicitly consider an interest rate cut or a hike. They still think underlying inflation remains too high. So it looks as if no early change coming out the RBA. But for what it's worth, the tone was certainly softer. They deliberately dropped the usual line about not ruling anything in or out, and it's warning about the need to stay vigilant to the upside risks of inflation. So, as I mentioned, probably no early move by the RBA next year, but it does look as if things are gradually starting to fall into place for some kind of interest rate cut further out. As far as New Zealand's concerned, well, the Reserve Bank of New Zealand, it's well on its easing path already, but only, of course, after being especially hawkish earlier in the year. Activity there is soft. The economy is suffering from significant excess capacity. And indeed, we saw a surprisingly steep 1% contraction in third quarter GDP. That came out just yesterday. And that's put the economy into recession again. So plenty of justification in terms of the real economy for further rate cuts. The RBN said itself as well, it's cut interest rates 3 times in the last 4 months, currently stand at 4.25%. But even in the last move, it noted that even the 50 basis point reduction, it leaves interest rates still in restrictive territory. So it looks very much as if we're going to see further rate cuts coming through there. And should be worth mentioning, I guess, that the bank is suggesting that they're looking to reach a neutral rate by the end of next year. And the governor believes that to be somewhere around 2.5% to 3.5%. So it looks as if there's probably at least another full percentage point, if not more, to go there during the course of 25. I mentioned India because it's one of those countries which is doing particularly well at the moment. There's little pressure on the RBI to come out and cut interest rates anytime soon. Inflation, 5.5% in November. So that's well above the central bank's 4% midpoint target. And indeed, on the latest in December, the RBI updated its forecast for growth and inflation. They're still very, very strong. Growth they got at 7.2% for the current fiscal year. CPI up at 4.5%. So really does suggest they're quite happy with where policy is at the moment. But just as an aside, maybe worth mentioning that the central bank has just appointed a new governor. They'll be replacing Shaktikanta Das, I hope I pronounced that correctly, who was widely seen as a main hawk on the RBI. So with his departure, it may be that opens the opportunity for at least a gentle downward trend in interest rates during the course of next year. So to Europe then, ECB, European Central Bank, cutting interest rates and a leading candidate for more next year. They moved by 25 basis points last week, so deposit rates now down at 3%, very much in line with expectations. And they reduced yet again their economic forecasts, and they still see downside risk to GDP as it is. Although the third quarter looked quite strong, that of course was biased up by the Paris Olympics. And the fourth quarter on current trends might even see a contraction. And the real problem for the ECB with the big two economies, Germany's really struggling. Third quarter GDP has only just reclaimed its pre-COVID level at the end of 2019, to put that into context. And in France, the central bank's just revised down its growth and inflation forecast as well. Now, both economies are suffering the fallout from real political uncertainty following the collapse of the German Olaf Scholz's three-party coalition recently. And in France, Emmanuel Macron, he lost his newly appointed PM the other week, and indeed was steadily increasing pressure on him to call early presidential elections. So there's plenty of political uncertainty, which seems now to be weighing quite strongly on business investment decisions by the corporate sector. For the ECB, there's certainly no complacency about inflation being under control. It's still above target at the moment, and indeed the core rate's still up at 2.7%. But from the way it's talking, it does seem as if recession risks are clearly now being taken much more seriously. So unless inflation does surprise, a good chance we'll see interest rates out of the ECB come down rather more quickly than some of the other major central banks next year. And I should also mention in terms of policy that the pace of quantitative tightening is set to quicken as we go through 2025. The old asset portfolio program, that's been declining at a predictable pace as the assets roll off the balance sheet. But from the start of next year, the pandemic emergency purchase program, there'll also be ending reinvestments there. So that means that the balance sheet reduction will be that much faster. Now, the ECB says that quantitative tightening and interest rate tools should not be seen in the same policy terms, but nonetheless, it could add slightly to pressure for rate cuts out there. In the UK, again, interest rate cuts very much on the cards as far as 2025 is concerned. The Bank of England announced earlier, just a few hours ago, that they'll be keeping policy on hold for now. But of note, 3 of the 9 members on the MPC actually wanted to cut rates. So that certainly increases the chances we'll get a move in the first meeting of 2025. Economy-wise, seems to have been a fairly marked loss of momentum over the course of the last quarter or so. GDP contracted in October for the second month, only down 0.1%, but it's caused the bank to revise down its fourth quarter growth expectations now to 0. And looking at other surveys, the broader picture is one that economic growth is slowing. The economy could well struggle to post positive growth over the next couple of quarters or so. However, although all that points towards lower interest rates, the labour market continues to offer mixed signals. On Tuesday, we had a surprisingly sharp jump in wage growth, and that certainly won't sit too well with the MPC's hawks. And as the bank's already previously noted, budget effects are uncertain, particularly implications of sharp increase in national insurance surcharges, etc. So overall, it looks as if rates will be coming down, and indeed the Bank of England governor is already on the record saying that if its own forecasts are broadly accurate, bank rate could be reduced by a full 1 percentage point next year. But do keep an eye on wages, because if we don't see some softening coming through there, it's going to be difficult for the bank to ease aggressively. I'll round off, as ever, with Switzerland. Amongst the banks cutting interest rates very sharply, they're pretty well leading the pack at the moment. Another 50 basis points off their policy rate last week, so that now stands at just 0.5%. Very much, very much underline their concerns about what's going on in terms of deflationary pressures out there. Their updated forecasts show average inflation next year only 0.3%, and even a 0.8% in 2026. So the way things are going at the moment, the economy is sluggish, inflation is close enough to really raise significant deflation worries, and of course they've got a very strong exchange rate there as well. They've already indicated that they are willing to take interest rates sub-zero, although they're loath to do so, but it's certainly not impossible if we see geopolitical instability, or whether it might be leading to further strengthening of the Swiss franc, we could see Swiss interest rates actually go negative. So there we are then. In conclusion, I guess it's pretty reasonable to expect a general, but perhaps only measured downtrend in global interest rates next year. Japan being a notable exception, of course, although even here, as we mentioned, policy looks like if it's going to be tightened by only quite limited and a gradual amount. Still, as ever, there are lots of unknowns that can and probably will upset the financial apple cart, not least the return of Donald Trump to the White House. So, as we always say at the end of each podcast, do make sure you keep up to date with all the key market moving data and events in Econoday's global economic calendar. And with that, on behalf of Terry, Max, me, and indeed the whole Econoday team, here's wishing you happy holidays and a safe and profitable new year. Bye for now.